The information in this podcast is current on the day of recording. It is general advice only, does not take your personal situation into account, and may not be suitable for you.
Welcome to Stock Tech. My name's Gaurav Sodhi. Joining me today is Research Director Nathan Bell. Hey, Nathan.
Hi, Gaurav. Glad to see you remembered your own name then, given this is take two.
This is take two. Thank goodness for the magic of editing. Making his Stock Tech debut today is new analyst Angus Donohoo.
Hello.
Did I get that right, Angus?
You nailed it.
Oh, man, it only took two turns. It's not too bad, actually.
I have a pretty weird surname. I think my ancestor was drunk and Irish and couldn't spell.
It's got that air about it. It feels like a mistake.
Yeah, I think it was a typo that's just moved through the ages.
The first time I saw it, I actually thought it was an error, and I corrected it, thinking that I knew your last name better than you did.
What was difficult was when I lived in Woolloomooloo, and then I had Angus Donohoo from Woolloomooloo.
Yeah, no, that sounds like a limerick waiting to happen, actually. Yeah, we'll do dirty limericks in part 2 of this episode. In part 1, Angus, tell us a bit about yourself. Actually, we went through a few people before we got to you, but your application really stood out. A, because it was unusually well written, but B, your background is just fascinating. You spent 2 years working side by side with one of our investing heroes and industry legend, Kerr Nielsen. And that was, I think we wanted to get you into the office just to talk to you about that experience. And then the job thing came afterwards. But it was a really interesting. Give us a quick insight into what that was like and how you survived.
Yeah, thank you. I've certainly had, I guess, a idiosyncratic career. I moved to America when I was just when I finished university, and originally started working at a magazine in Hollywood, of all places. And I did that for a few years. And then I started working in technology and worked in cryptocurrency through that second boom.
You've just lost half the audience right there. Everyone's
That's right, yeah. But it was a fascinating thing to have seen. And I met a lot of people who kind of purported to be investors, but who I certainly do not consider to be that. There was a lot of wild speculation, and there was all sorts of shady people you would meet, but it was just a fascinating world in this, explosion of technology. And interestingly, Kerr actually, he did that. There's a platinum letter you can go back and read about Bitcoin in 2014.
Oh, wow. Okay.
And you could think about, it would be quite a funny thing to do, to look at what would have happened if Platinum had put $1 million in Bitcoin at that point in time, because it was probably about $600 or something then. Wow. And they didn't buy it, and their analyst didn't like it so much. And I've known Kerr for years, and I sort of reached out to him to sort of ask about that article, and he sort of sent me through the work that his analyst had done on it, and I sort of critiqued it a bit. Anyway, skip forward years later, and when I moved to Australia, Kerr and I actually started talking again about crypto. That was sort of before the latest boom, and we started playing with a bit of money and running a bit of a crypto fund. Did very, very well out of that. And he said, well, this is all, I won't use his exact words, but this is all nonsense.
You can say it. You can say it.
This is all bullshit.
It is all bullshit.
Why don't you come and I'll teach you how to properly, run stocks and teach you about stocks? So had just an extraordinary opportunity and got to work with him for 2 years. He's an incredible character, a very brilliant individual. And, taught me a lot of really important fundamental things about stocks and about assets that compound cash flows.
Yeah. No, there's a lot of lessons there. We need to have a reckoning one day about Bitcoin.
I'm pro it, but I know I'm in a minority.
Yeah, no, that's why I was so fascinated. I think you had some interesting points about Bitcoin. Well, we'll do that another day, because I think I've been on record as saying, not Bitcoin per se, but cryptocurrencies, I call the greatest bubble since tulips, maybe of the last 2 centuries. So we need to hash that out at some stage, Gus, but not today. Today we've got something probably even spicier than that, if it's possible. Dating apps. This when you first proposed this kind of came out of the blue as well, and I thought it was a really interesting idea. And you did a deep dive. on dating apps. The written research is on the web, but as always, there is so much more we could talk about with dating apps. First of all, when you brought this to the table, Nath, I don't know if you agree, but I had expected these businesses to be the typical outstanding software network effect businesses. I expected financials to be, if not obscenely good, on their way to be obscenely good. And we got something quite different. First, Nath, tell us about your initial ideas of what the dating apps might look like, and then Angus, we might get you to tell us the reality.
Well, because I worked on an international fund back in 2015 to 2018, I did a few trips to Omaha. That was our annual trip as a team. And one of the guys, a friend and ex-colleague of mine, was a fair bit younger than I was. So he was all over the dating apps at every city we went to. So you could see how much they were being used. And he was giving us a blow-by-blow account of which ones were working better than the other ones. And
well, that sounds like the dating apps dragons then. That's pretty much what Gus did. He just gave us his own personal history of each one. We learned a lot about you that day.
I just couldn't have thought of anything worse myself. I just never had the confidence to imagine a young Nathan Bell being on there just flicking right and left and meeting these people. Like, I just couldn't imagine it. It's just so not me. But here was this just complete change in the generation where they just had all the confidence in it was just no bother to go and meet someone, a random person basically, which was, I just felt, it was really unusual, particularly from someone who comes from a country town where everybody knows everybody. So that was sort of my first exposure to it. But already, we're talking about this is, 7 or 8 years ago. Already at that stage, there were multiple options for people, and they were actually there's a book, and I actually can't think what it's called. It might have been called Stop, I think. But what it talked about was how industries split underneath each other. And basically it just means it starts out quite broad, but then they become specialized. And that's what was happening with the dating apps. Everybody sort of knew Tinder, but then, there was Grindr and all the rest of them, and I'll let Angus take over in a second. But they were dividing underneath each other, so they were becoming more specialist. So that told me that they weren't the bulletproof sort of internet franchises that you, like a Google or a Facebook or whatever, which are just very broad, dominant, and there's really no other options. You just use those. This was very different. So it told me there was competition. And also just because of the nature we were looking at these as investments as well, some of the people involved and the amount of spending that was involved, there was all these things going on. So it was a really active space, and it was really growing fast. But it did actually have some very different, mechanics than what some of the other internet businesses had. So with that, I think you can go to Angus, who can tell you from a user point of view as well as the analytical point of view.
Yeah, I think these apps, the sort of expectation that even I kind of naively went into was that, they would be a bit more like a Facebook or another kind of social network like a Twitter. But the reality is that advertising is an almost inconsequential part of the businesses. For any of these, Grindr makes a little bit. They have about 15% of revenue comes through ads, but the others, it's only about 2%. And actually, these things work, I think, a little bit closer to something that would know from the gaming industry. They've got these very kind of fragile networks because they're purporting to be bigger than they are. Their actual number of active users, I think, is probably quite disconnected from the sense you get when you're on it, because people might set up an account, they might not come back and use it for a long time. But if they're an attractive person, their profile will be used to constantly market the app. And these things really kind of hack into your your reward systems in your brain and try to get you swiping and get you kind of coming back and then getting you to spend money. And I did start using them when I was living in Australia in about 2013. I think I did start looking at them, but they were very embarrassing then. I think there's been a lot less, there's sort of less social shame attached to them now that there was then. And it sort of wasn't something that I really enjoyed or found interesting. But then when I went to America, profoundly different dating culture. and the apps just worked so well. There was just, you could just be meeting new people all the time. Then when I came back to Australia at the end of 2020, after kind of COVID, when it was still wreaking havoc, but after it had hit, I was really kind of shocked here because in Australia, the apps didn't work nearly as well for me personally, and they were making you pay. So I just sort of straight away was like, wow, this must be a good business. But I think when I actually dug into it, and frankly, I put some money on the table and invested in some of these, and it hasn't worked out that way. And so in a way, what I was doing to some extent was kind of conducting a post-mortem of my own folly with why these things aren't good businesses.
And what did you find? Why is this not Facebook again? I mean, I would have thought the apps are the perfect intermediary between people, looking for partners and bringing two sets of people together. It ought to be a network, right? The more people are on them, the more people get attracted to them. So where does that fall apart?
It really comes down to who's sort of willing to pay and where they're collecting the money from. Facebook can be collecting ad revenue passively from, I go and look at Instagram and they're put six ads down my throat and they collect money from the advertiser for that. The dating apps have to be collecting the money from the user. And there's this huge structural mismatch between, a lot of people with dating apps, they say they want an authentic experience and they say they want true love and conversation and all of these things. But analytically, it's overwhelmingly comes down to how attractive a person is. All of the apps that have gone more for that, conversation basis, a more sort of authentic human experience, less visual, I suppose, have usually not really been successful businesses at all. Most of them have collapsed. And so, the way that these businesses actually collect revenue is by marketing to a person an idea of a potential romantic liaison with another person. And a lot of the payers, so it comes down to about something like 1 in 10 people are actually willing to spend money on these apps. And then it's only about 0.5% of the payers that will generate about 60% of the revenue. There's not that data, a lot of that data is kind of, there's conversations you can find between head of data for some of these companies. And there's also information that came out of the Epic lawsuit when Epic Games were suing the Apple App Store that sort of showed how hugely skewed these networks are. And it's really a power law distribution of people who are willing to pay.
Hang on, just put that power law distribution, just explain that concept. Not everyone will be familiar with it.
Yeah. So I mean, it's kind of that 80-20% rule that so 80-20 rule. So 20% of users will be spending 80% of the money. And that's I think a Pareto distribution you call it. But, in all sorts of different fields, a small number of participants are what drive the vast amount of the value that's created, or the, and this you find power law distributions all over the world in all sorts of different fields. A way of thinking about this is wealth distribution. So, you've got the top, say, 1% of the global population control 50% of the assets. And then the next 10%, they maybe control 30%. And then the bottom 50% collectively, they only control about 1%. Similarly, in dating apps, if you're if we get 200 people in a room, we get 100 men and 100 women. If you are the average looking man in that room, so you're the 50th most or 50th least attractive person, everyone below you in attractiveness, that bottom 50, they collectively garner about 1% of all of the likes that are distributed on the app. So if you're an average looking bloke or below average, you're probably collectively as a whole group, you're going to get 1%. Whereas if you're the most beautiful woman on the app, you're going to get more likes. Every single person will effectively like you. I don't know if that's helped with power laws.
It certainly explains that what I was seeing, 7 or 8 years ago, right, was there's, the good-looking people essentially looking for, they're going to be quite prolific, some of these people. So once they've gone through all the potentials, they're going to move on to the next platform. And if those power users move, then a bunch of people are going to move with them. But it leaves a whole bunch of, let's call a spade, I guess, the better looking people on an app that's used by a much smaller group of people, and a lot of other people left on the other app that's all of a sudden it's sort of lost its buzz because they don't get to see the good looking people on there.
Yeah, there was an anecdote that I didn't actually include in the article, but it sort of, I think, is kind of revealing, which is that a friend of mine, an attractive girl, visited me in Los Angeles, was there for 2 weeks or something, went back to Australia, had not been in Los Angeles for 18 months, had gone into a very serious long-term relationship. I'm on the dating apps and I look and she pops up. Now, maybe this was a bug in the system, but, there would have been people spending money to try to get a super like with her, or to try to send her a direct message or whatever it is, because a lot of the way these apps charge revenue is you either pay for a subscription to the app, which kind of gives you enhanced access to the network. They're mostly freemium networks. You don't have to pay to have a sort of basic membership. And then you might pay extra, what they call a la carte fees. So you might spend an extra $5 to send a super like to a person that you're interested in. And if I go back to my original investment case, what had sort of impressed me, I'd never kind of thought the subscription model was very compelling, but it did seem that some of these a la carte purchases, this ability to spend that little bit extra to get, enhanced access to the network, I thought that those were going to be really effective at collecting revenue. And I think they probably have generated some, but, I don't think they've been as effective as certainly as the dating apps would have liked.
You only need to look at
sorry,
REA.
Gaurav, I was just going to say, it's like you're playing an inferior poker game.
It's exactly like that. I think that's exactly right.
You only need to go over and look at REA to see how that model works really successfully. So REA's actual volumes don't change too much, but the fantastic profit growth is really coming down to how they encourage individuals to pay more for individual listings. And that can be premium listings, and their prices just keep going up. But when the site was first launched, it was just a very basic, pay once, and that's all you paid until the house was sold. And as it's developed, people have just paid more and more to get on top of those lists and to be more prominent.
Yeah, and I mean, I think if you sort of step back and kind of look at the network, so the industry. So there's 3 publicly traded players. 2 of them aren't profitable, both of which, have optimistic forecasts that they'll be profitable soon. And then Match Group is profitable, but probably not quite. They're all sort of on a 70% gross margin, but then they spend hugely on stock-based compensation, on actually just on, a lot of their marketing costs are huge. And you would think that if these were stronger businesses, they kind of, they wouldn't need to be spending quite as much as they do to, keep users on the platform. And another thing that's sort of interesting here is Match Group took this real monopoly approach. They own the most highest revenue generating app. They own the third most highly revenue generating app. They own sort of 6 of the top 10. And the idea being that, you can collect different users in different marketplaces. You can be sort of tuning into different cultural sensitivities, tuning into different phases of life. But there's sort of also a downside to that, I think, which is something that I haven't really seen explored elsewhere so much, which is if you just look online, if you look at Reddit, or if you look in, Better Business Bureau, there are huge numbers of complaints about these apps, and they almost all relate to bans. And what's extraordinary here is these apps have become such dominant parts of our lives, but it's a monopoly, and there's really just sort of 2 players. And so if you do get banned on one app, you get banned across the whole lot of them. And I think because of that power law distribution and how few people there are who are actually willing to pay and be the super users, if you've got a network that's banning them, I don't have great quantitative data on this because it sort of doesn't exist, or I haven't really been able to find it, or I haven't, spent the months that would be required. But, just as a sort of thought experiment, it's fairly logical that if you are banning these power users across your entire portfolio of apps, you're creating a situation where it just gets harder and harder to actually really grow that top line.
Is that the big difference between something like this and other like network businesses? Is it that, something like Facebook, really, did they grow their revenue? And that's right. Something like Facebook, their revenue model is about advertising, and no individual has to pay to use the network. In REA's case, which is probably one of the most successful one of the network businesses around, the agent is responsible for selecting and listing, but the client is responsible for selling. And they may pay a few $1,000s to sell a house worth a few $1 million. So the fee as a proportion of the total sale is tiny. But here we're talking about the individual forking out cash and potentially being on multiple networks. It ends up being quite an expensive endeavor, I imagine. So is it the actual revenue model itself that's the problem?
I think so. And I think fundamentally you're paying, but not necessarily getting what you're paying for. There's a huge structural mismatch. Some people don't need to pay and get exactly what they want, whereas some people need to pay a lot and still might not get anything. There's no actual control over the end product. So they're selling a product that they don't control, which I think is not usually ideal for a business, because you can't really sort of satisfy your customers. It's interesting that there's a guy did a study on it, applying the Gini coefficient, which basically is this measurement of how unequal or how equal a society is. So a country like Australia has a relatively high Gini coefficient. It's gotten worse. A country like Saudi Arabia, it would be extremely skewed. Dating apps would be the most unequal societies in the world if they were kind of measured on a Pareto. Not on a Pareto, on a Gini coefficient. So there is just this huge mismatch in the actual structure of the customers' desires, what they're paying for, and what they actually get in return.
And it sounds like they're just not great products. I mean, as a solution to a problem, it's just not a very good one. And that might be, actually, we're talking about revenue models and all these specific things, but the basic truth might just be this is not a great solution to the problem it's trying to solve.
I think that you might be spot on that. And an interesting thing as well from that perspective is, for a long time, I think a lot of the kind of bear cases attached to this, the sort of skepticism attached to these apps, was that someone could just go and send a direct message over Instagram. And there was evidence that people were using more traditional forms of social media apps to kind of do the same thing. And Facebook even tried to launch its own dating app. But interestingly, Facebook's dating app has really not succeeded. And I think it's because there's, people probably don't want to be using the same app that they speak to their aunt on, or where their aunt comments on their photos with chasing someone for a date. So the businesses should have got stronger, but you just match groups growing at 5-6%. That they're not, and they're quite saturated. There's, I think is it 250 or 350 million people in the world using these apps.
Yeah.
So it's a big number.
I think that's also what raises a red flag for me. This is not like Facebook 20 years ago, when it was just scaling and you could see user growth growing and there was all this potential. These are already at scale, and there's still, the economics aren't working.
Yeah.
Okay. So I just wanted to give an update on BHP. Now, last week, everyone knows by now that they made an approach to Anglo American about a potential takeover. Nothing formal has yet landed. But they're going to have to act soon, because there are quite strict rules on takeovers, and you can't just talk about a bid idly. You do need to, if you're interested, you have a limited amount of days before you need to launch one. So expect a formal bid coming from BHP for Anglo at some point. It's a big deal because it's a $40 billion pound potential bid, which is, something like $60 billion. It is one of the biggest mining takeovers for decades. And it ends the epoch of careful, considered capital allocation. And many fear that it relaunches us back into the history of silly, crazy acquisitions and unthoughtful production growth. That was my initial reaction when I first heard about this. I just instantly, my stomach went to the bottom, and I just groaned and thought, "Oh, not again! What are you doing?" But having gone through the details of Anglo, a business I was not all that familiar with, I can actually understand what BHP is trying to do here, and I think I am supportive of the idea, particularly if it can be done at somewhere around the current price. Now, Anglo has been a disaster for a good 5-6 years at least, and probably longer than that. It's arguably been the worst performing large miner in the world. Some of that is due to poor management and capital allocation. They bought into assets that haven't really worked out. For example, they bought a big a fertilizer business that looks like it's a bit of a stinker. And yes, did you see what I did there? And that's a big, expensive waste of money. But they've also been the victims of a lot of bad luck. They co-own the largest manganese project in the world. That project was devastated with a cyclone, and so it's all gone kaput. Platinum and diamond industries, which are two traditional strongholds of Anglo American, where they hold wonderful assets. Those two industries have arguably been disrupted. Diamonds from artificial diamonds, lab-grown diamonds, which are now taking over the world. There's no question that's actually now a proper movement. And platinum from the rise of electric vehicles. The greatest growth case for platinum was really the use of platinum and palladium in catalytic converters for traditional cars. And that's fallen off a cliff as well. So they've been the recipients of bad luck as well. So this is actually a well-timed bid for Anglo American. The attraction is twofold. They own metallurgical coal assets in the Bowen Basin, where BHP also owns its wonderful coking coal mines. And these are high-quality assets, and there is sure to be some synergy. I'm sure there's infrastructure agreements that can be reached. There's asset sharing that can be done, and I think that can actually work by combining Anglo and BHP's met coal mines in Queensland. That's a pretty good, sensible deal. The other one is access to Anglo's enormous portfolio of copper mines. Now, not all of these are 100% owned, but the copper deposits that they own are genuinely enormous. And it's getting really hard to find large copper projects. There's only a handful in the world. And Anglo has its hands on quite a few of them. These haven't really performed all that well in Anglo's hands. The copper can be, especially at such a large scale, it can be a difficult thing operationally to get up and running. But BHP has more experience than anyone else in doing this. They've run the Escondida mine for decades, and you can argue about whether that's been successful or not, but they have learned a thing or two about how to build a very big copper mine. So I actually think there's some operational efficiencies that they can pull out, and they have a balance sheet that they can deploy to actually develop these projects the way they're supposed to be developed. So I think that makes some sense as well. So all of that is saying that I initially felt dread, but now I am coming around to the idea, I think this may be a sensible acquisition if it can be done. And they've also proposed quite an innovative structure where they're getting Anglo to hive off all their South African assets before BHP buys it. Excellent idea. You don't want to get caught in South Africa. So look, rather than being really fearful of BHP returning to its past, its long past and an awful acquisition history, I actually think this is a continuation of the good BHP.
Just very quickly, Gaurav, do you think the fact that it's an all-scrip deal turned Anglo off in any way?
No, I don't think so. I think that it's natural for an Anglo investor to be interested in BHP scrip. The biggest shareholder, by the way, is the government of South Africa. That's probably the hardest part to get through for BHP, because Anglo is something of a South African national champion. The business began in South Africa and employs tens of thousands of people there. It's a huge taxpayer, and the South Africans would be poring over the details of that deal. Something they have to appease them somehow. So I'm not sure what their plan is to get past that major shareholder. But everyone else, I would imagine, will be happy to take BHP scrip.
It's like iron ore, obviously, is what BHP is really about. So it's quite a different business to what the other investors have been buying it for or in the shares for. And obviously, it's a huge sum of money to take a bit of selling. There's a bit of risk around that as well.
Management have been very, very clear at BHP for a number of years now. They have been looking for ways to grow that copper portfolio. They want copper to be at least a third of earnings. And they have they've done some really smart stuff. So I thought the purchase of Oz Minerals last year for $10 billion was an outstanding deal. And they've got really intelligent plans for integrating that mine into a much larger complex in South Australia and building an enormous copper province there. BHP, even without this deal, may well be the world's largest copper producer. There's a couple of national mining champions that might challenge them. But in a few years, I fully expect BHP to be the world's largest copper producer. This adds about 50% to their copper output. And, I probably don't share the market's enthusiasm for copper. I don't think it's a terrible asset, but I don't think, I'm not convinced that it's in some long-term structural growth trend the way iron ore has been for the last 20 years. But these are fundamentally good assets and the prices sounds reasonable. So, yeah, interesting deal. Angus, so has copper taken your fancy?
Not from an investment point of view. I think where I think copper's an interesting asset is, and this is one of my slightly fringe thoughts, but the electricity grid is so reliant on it. You need huge amounts of copper in transformers, and if you got a big solar storm coming through, you would wipe out an electricity grid. And we don't have the kind of copper, because it's not just you sort of got to use some amount of there's specialization in the way that you use that copper. We don't have the kind of the replacements ready to kind of push into place. So if you ever got a really big solar storm, there would be an enormous rush for copper, and I think that's quite an interesting angle. But obviously, that's a very, very hard thing to kind of invest in preparation for. But I think that's sort of where it has caught my eye.
One day you have to talk to us or write to us about solar storms, because it's something that comes from you quite a bit, and I'm interested in the details. But Nath, give us an update before we head off about the funds. We've got you're doing a webinar shortly about the funds. It's been quite an eventful year so far. So how are they traveling and what's coming up?
We do have the annual Growth Fund secondary offer. I think the webinar's on the 23rd of May, and Gaurav is going to join me on that and talk about RPM Global and Mineral Resources as two of our largest holdings. So I just wanted to make the point that even if you're not interested in investing in the fund, you might want to watch the webinar anyway. But also you can ask questions. So if you have some good questions, whether it's about the funds or just about a particular stock or whatever, usually we're very happy to answer it on the webinar. So hopefully the webinars are a bit more useful broadly than just to those interested in investing in the fund. So that's one part. The second thing is particularly for newer members who may not be familiar with the website, the model portfolios on the website are an exact replica of the funds. They're just the data is just slightly delayed because we have to publish the holdings on the ASX website before we put them up on our own website. But in terms of returns, it makes no difference. But they're quite useful, I think, particularly underutilized, I think, by newer members who come on board and just see all these stock articles coming out each week, and it's a lot of effort to read it all, and it can be reading Mineral Resources isn't like reading a very simple article about a bank or something like that. It's a just extraordinarily complicated business with 4 divisions and all that sort of stuff. So we understand that this can take a lot to get your head around, and then you've actually got to work out which are the best stocks to put in a portfolio and assemble them in the right amounts and all that stuff. So those model portfolios are always there, and I think they're extremely valuable, and I think they're a part of the website that isn't used very often, but probably should be used by more people. Once you're experienced and you know what you're doing and you know what type of stocks you like and what opportunities, then you may not be interested in how we're our position sizing and all that sort of stuff. But the position sizing to me is the most important part of investing, and it's the most boring to talk about, and there's no science to it. It really is an art, but it is absolutely the most important thing in investing. So it is often worth having a look and just seeing how we've positioned the portfolios. The funds are all going really well at the moment, as you'd expect. NF, the income fund, is the one that's lagging a little bit, but that's always going to happen when you're in a red-hot market. Income funds aren't designed to keep up in...
And when BHP launches a $60 billion takeover, probably doesn't help.
And the other thing, the point I was going to make was it's normally, you do expect income funds to lag, and you do expect value portfolios to lag as well in hot markets, but I don't accept that, because I think if we pick our small and mid-cap and growth stocks right, that we actually do well in pretty much any conditions, which is not to say we do well all the time. When you're buying out of favour stocks, you're going to go through a period of underperformance, but it just depends for what reason it is. And at the moment, I actually think it's the reason we're not doing even better versus the market is the impact of index funds. You've got plumbing company Reece at the moment trading like an AI stock at 40 times earnings, which is just outrageous in my view. You've got Commonwealth Bank trading at the same multiple as Google. Like it's just ridiculous. But these index funds have got to put all this money to work in basically the top 20 stocks. So they're getting all the money. And as each share price goes up for those stocks, then all the other index funds have to follow them up to stay balanced. So you've got that going on in the market, and that's keeping the market really strong. So our absolute returns are great, but the reason we haven't separated ourselves from the index as much as I would like at the moment, I'm always chasing the 3 to 4% annualized outperformance, which I think is what I think 2% is always a pass for us. 1 to 2% is always a pass, but I really feel much better when we're doing a 3+. And the only thing that's holding the portfolios back at the moment versus the index or the market is just that our small and mid caps, I wouldn't say they're being completely ignored, but some of them are. And I look at something like MA Financial that's potentially trading on 14 or 15 times next year's earnings. And I'm not saying these businesses are as high quality as all the popular stocks we all know well, but it's just in terms of pricing, that this seems like apples and oranges to me. You've got Macquarie that trades on about the same multiple or higher, extremely large business, obviously higher quality, but its growth prospects are far, far lower. Like personally, obviously this is just for me, and I'm not the average investor, but I'd much rather pay 14 times for MAF, which is owner-led, has a big future in front of it, than pay 22 times for CBA with no growth prospects. And you'll be lucky to just get the dividend yield over the next 10 years. So when you're seeing it everywhere at the moment, you're seeing all these small cap managers complaining about they own all these really cheap stocks and how bad small caps have performed versus these big stocks. And like those are just a couple of examples of why. But we're going to discuss these things also in the webinar. But I just wanted to make one more point. It's just a few stats I've taken, and I'm sure people have read these everywhere. And again, these are just broad general stats, and we're about picking individual stocks. But I hope I've at least provided a couple of quick examples of specific examples of this misvaluation, in my view, between the big and the small. So I'm just going to read these out. So I've just copied these from someone else's letter. It's worth noting that from 2000 to this is from the US, but it's essentially the same trend in Australia. It is worth noting that from 2000 to 2006, small cap value had annualized returns of 16%, while the S&P 500 was closer to 1%, and longer duration equities generated negative annualized returns. So for anybody who's been following, the big stocks and small cap part of our market, like that sentence, you can just pick that apart with names. Like you've just seen, Goodman Group comes out and announces they're going into data centers, and the share price just takes off. Just anything to do with AI, like it's just people will pay any price for them. And the fact that you can tell that people aren't actually looking at the value and the fundamentals of these businesses is when you see Reece trading at 40 times. I mean, this is the most stable, predictable business just about out there. To be trading at 40 times earnings is just mental, I think. Two more quick ones and we'll finish off. In fact, you would have to go back 90 years to find small caps under a 4% weighting in the US market. So again, it's just interesting. Like you've got to go and decide, you could take advantage of this just buying a small cap ETF or something, but we do it by individual stocks. But just when you see these sort of facts all lining up, there's some truth to it. And the last one is the top 5 combined market cap stocks in the US is now 3.3 times the size of the entire Russell 2000 index.
Wow.
That is more than 2 times the level in the tech boom in 99, 2000. So they're just astounding statistics. So in terms of, I just think it's really interesting at the moment is normally when you have a market this fully valued and you can see that it's particularly index funds that are just paying these crazy prices, normally historically I get really frustrated because there's just nothing to buy because everything's up. And actually that's not the case this time. Like we own all these other stocks that we're going to talk about in the webinar, and I've mentioned that I just think are extraordinarily cheap when you look out 5 years. Like the returns may not come instantly, but I just see they're all powered by the right people. doing the right things, and they trade at these really low, like any time, whether the market's fully valued or low. These are just, I just think, are cheap valuations because they're just not what these big index funds are looking for. And I think, if I'm right in saying this, passive funds last month overtook the amount of money actively managed in the US. But I wonder, that actually didn't sound right to me because I think that already happened quite a while ago. So I actually wonder whether maybe that was just purely ETF money has surpassed it for the first time. But whatever it is, it's just, these big, huge funds are fighting with themselves to buy the biggest stocks because they're just so huge. They're not interested in value and they can't put a lot of money into these small caps. So if you're the sort of investor that does actually want to see and look for value, to me, it's just plainly obvious where it is in today's market. And that's the first time this has really happened in my career. Normally, either everything's expensive or everything's cheap. And that's just not the case at the moment. So it's actually a good time to invest when normally I'd be, frustrated about trying to find ideas.
There you go. Come for the stock ideas, stay for Angus's dating history.
Then that was a power law distribution. Gee, that's extraordinary. The three top companies.
That is a power law distribution. You're right.
Yeah.
We're back to where we started.
Yep.
And I would say just quickly, like
closure.
The one thing that is different is that, these $1 trillion tech companies are, you can't compare them to the multi-billion dollar companies that all got crunched in 99, 2000. It is different, but it doesn't change the fact that people have just wanted perceived certainty, and these index funds are having an impact on the market like we've never seen before. So I've actually been trying to think of ways to take advantage of that, but maybe that's a discussion for another day.
I remember when I first bought Apple stock, it was a $300 billion business. And I remember all the brokers saying, it's too big. The law of large numbers is going to get in. Yes, it may have 20 bagged over the last 10 years, but it's not going to double again. And it's now 10 times what it was at that price. I think it just goes to show that these, $1 trillion market cap, $3 trillion, there's no inherent limit to how large these large numbers can get. And we think
especially when they control as much power as a country,
more than a country, far more.
Indeed, yeah.
Well, thank goodness it's not Tinder though, right? It could be worse.
I don't think that'll be a $1 trillion company, but who's to say?
Right, Angus, fantastic debut. Great to have you on board the team, and thanks for joining me today.
Thanks so much. Thrilled to be here.
Nathan, we will catch up in the webinar. When's that happening again?
23rd of May, I believe, so Thursday.
23rd of May. And how do people access that?
The emails will be coming out in a couple of weeks, so people won't miss it.
Wonderful. Okay, look out for that. Thanks for joining us today, Nate.
Thanks, Gaurav.
For everyone else, thank you for listening.